Keith, I read your note yesterday after the Fed. You thought the market was ripe for a rebound, given some of the negative sentiment. The opposite is happening today. What do you make of it?
Yeah, I think Louis Rukeyser said, don't put something in print that you can be wrong in 24 hours. But yeah, today is surprising as far as how much we've come down. I mean, we did downgrade equities in April, and part of that was concerns around a Fed policy mistake. But as Mike discussed, I don't think it's appropriate to become more negative now as prices have moved down. I mean, at this point right now, there is concern about the economy slowing down, but with markets down about 15%, you're already pricing in about 50% chances of recession. We think that's too high. And as Mike also discussed, we're above the lows from earlier this week. So we have the employment report tomorrow. We have the CPI report next week as well. So I think that will be really important. But again, I want to become more bearish as prices have gone lower here.
We are making new lows as you speak for the day. We were as low as 1243 on the Dow. We're now down below that, about 1240 or so. So Shannon, would you buy on a day like today, or you just have to step aside?
I think that when we think about the next probably 3 to 4 weeks, Sarah, we're really thinking about that chop that Mike just talked about. And certainly if you're a long-term investor and you're looking out the next 3, 4, 5 years, there's absolutely no reason to not buy high-quality companies in this type of environment. With that said, if you're thinking about averaging in, if you have cash on the sideline, there certainly are going to be a number of opportunities over the next couple of weeks. I think the most important thing that we're thinking about is just that consumer aspect of the data that you mentioned, and thinking about what does a lower growth consumer spending environment look like in the back half of this year and into next year, and really thinking about where you want to be exposed there. So again, going back to the data, that's what the Fed is doing, and that's what we need to be doing as investors as well to make sure that we're appropriately positioned and going into companies like in technology where you're focused on enterprise spending. That is not going to slow substantially over the next 5 to 10 years. And so for the long term, that's what you need to be thinking about.
So you actually like some of the names in technology then? Is that what you're saying?
Absolutely. Sarah, technology is still the largest weighting in our portfolios. And although we've trimmed those positions several times over the last year and a half, if we look at, what's going to drive growth in earnings, what companies can continue to grow their earnings over the next several years in a lower growth economic environment, I think there's several quality tech names that can do that. And it's not just tech, it's healthcare, industrials, looking for companies that do not need a strong secular economic tailwind to necessarily drive earnings growth is what you need to be focused on over the next couple of years.
Like what? Because Apple, Microsoft, they're all getting thrown out today. Take your pick. So how do you choose quality within tech? And I want to press you on it, Chen, because we're seeing more than 5% decline for the NASDAQ.
Yeah, so, our largest positions, Sarah, are names like Microsoft. We like Salesforce. We like the digital transformation aspect of what's happening in the hybrid world. We have large positions in Amazon, certainly on the back of the AWS and advertising part of the business, which is obviously the higher margin, higher growth part of the business. Those are names that are large holdings in our portfolio and are going to continue to be so. And in fact, although we're not adding today, there may be opportunities to add to some of those positions, particularly one like Amazon, over the course of the next couple of weeks for the long term.